Hello students, welcome to Accounting Explained at AccountWise Academy. This is Latha Venkateshwaran. In today's video, we are going to see straight line method of depreciation. Today we are going to see a problem that you might encounter on an exam for straight line method of depreciation. We shall break down the problem step by step, providing clear explanation, and we can see how to apply it. So whether you are studying for an accounting exam or simply want to improve your financial knowledge, this video will be very helpful. So in this video we are going to see adjustments in the straight line method when assets are purchased on different dates, when there is a sale of asset, and when there is loss on sale of asset. Let us see the question now. B company purchased machinery as follows. Date of purchase, cost of machine. On 1/4/2016 it is 60,000. On 1/10/2016 it is 40,000. On 1/7/2017 it is 20,000. So he has bought machineries on 3 different dates. On 1/1/2018, 1/3 of the machinery which was purchased on 1/4/2016 became obsolete and was sold for 6,000 rupees. So the machinery which was purchased on 1/4/2016, of that 1/3 of the machinery became obsolete and he had sold it for rupees 6,000. The machinery was to be depreciated by fixed installment method at 10% per annum. The another name for straight line method is fixed installment method. This we have seen in the previous video. I will share the link of the previous video in the description box for the introduction for straight line method. Show the machinery account that would appear in the ledger of the company for the years 2016, 2017 and 2018, assuming that the accounting year of the company ends on 31st December every year. So the accounting year is from 1st January to 31st December. Before opening the machinery account, we are going to do some working notes. That is, we are going to first find out depreciation for 2016, 2017 and 2018, and then we are going to find out whether we have got loss or profit on sale of this machinery, okay, which was sold on 1/1/2018. First we will proceed for the calculation of depreciation for 2016. That is our working note A. When did we buy the machinery? We bought the machinery on 1/4/2016. See here, 1/4/2016 we have bought for ₹60,000. So 10% on 60,000. 1/4/2016 means from April to December we are going to calculate. So April to December it is 9 months. So we are going to calculate pro rata depreciation for 9 months only. For 9 months, 60,000 into 9/12, rate of depreciation here it is given as 10%. See here, 10% into 10/100, which amounts to rupees 4,500. Next, second machinery we bought in the same year 1/10/2016 for rupees 40,000. So it is from October to December, 3 months depreciation we are going to calculate for the value of 40,000. So 10% on 40,000 for 3 months. 40,000 into 3/12 into 10/100 it is 1,000 rupees. So total depreciation for 2016 it is 5,500. That is our working note A. Next comes our working note B. That is for the calculation of depreciation for 2017. It is this both machineries together it amounts to 1 lakh, which we bought in 2016. Okay. So 10% on 1 lakh for 1 year straight we are going to take 60,000 plus 40,000, that is 1 lakh. 1 lakh into 10/100, 20,000. Next, On 1/7/2017 we bought machinery for 20,000 rupees. 1/7/2017 to 31/12/2017, it is 6 months. So 10% on 20,000 for 6 months, it is 20,000 into 6/12 into 10/100, it is 1,000 rupees. Total depreciation for 2017 amounts to rupees 11,000. Next we are going to calculate depreciation for 2018. 2018, see, on 1/1 starting of the year 1/1/2018, one third of the machinery which was purchased on 1/4/2016 became obsolete and sold for 6,000. Okay, which was bought on 1/4/2016. What is the value of the machinery which was bought on 1/4/2016? It is 60,000 rupees. So 1/4/2016 value of the machinery is 60,000. On that, one third of the machinery was sold. How much is one third of the machinery? 60,000 divided by 3. It is 60,000 minus 20,000, 40,000. That is the value of the machinery as on 1/1/2018, which was bought in 1/4/2016. Okay, so we have to take only this value for depreciation. Since it has been sold in the starting of the year, depreciation is to be calculated for the remaining machineries for the whole year. Okay, see here, 10% on 60,000 minus 60,000 into 1/3. This is what we have done here. For 1 year, it is 40,000. 40,000 into 10%, it is 4,000. Okay, next, what are all the remaining machineries now? Which was bought on 1/10/16, it is 40,000 rupees, and which was bought on 1/7/17, it is 20,000 rupees. Total is 60,000 rupees. Okay, on this 60,000 rupees, for the value of the machinery for 60,000 rupees, we have to calculate depreciation for the whole year. So 10% on two machineries, 40,000 plus 20,000 into 10%, it is 6,000. So total depreciation of 2018, it is 10,000 rupees. The next working note is to find out whether we have earned profit or incurred loss on the sale of machinery. See here, on 1/1/2018, one third of the machinery which was purchased on 1/4/2016 became obsolete and was sold for 6,000 rupees. So one third of the machinery, 60,000 is the value of the machinery which was bought on 1/4/2016. So of that, one third is being sold. Divided by 3 is 20,000. Cost of machinery on 1/4/2016 is 20,000. Okay. Less depreciation for 2016. We have bought this machinery on 1/4. So already we saw that for 1/4/2016 machinery which was bought, we found out depreciation for 9 months only. So for 20,000 also we will find out for 9 months only. 20,000 into 9/12 into 10% is the depreciation for 2016, amounts to 1,500, which has to be deducted. Then 2017 we can take the whole of depreciation, the whole year depreciation. 20,000 into 10% we take it straight, less 2,000. Okay, so book value of machinery as on 1/1/2018 is 16,500, less sale value of the machinery on 1/1/2018. How much we have sold that machinery for? We have sold it for 6,000 rupees. So that has to be deducted, less 6,000. So here what we are finding out? Book value is greater than the sale value. So we have sold the machinery for loss. Loss on sale of machinery is 10,500. Now it's very easy to prepare the missionary account. Missionary account is a real account and all purchasing of assets will be debited to the missionary account and all sales will be credited to the missionary account. And the balance which we get in the missionary account will be transferred to the asset side of the balance sheet. Now let us prepare the missionary account. This is the missionary account and on the left side is a debit and right side is the credit. We have 6 columns here: date, particulars, amount, date, particulars, amount. In the sum, on 1/4/2016, we have bought the machinery for 60,000 rupees. So on 1/4/2016, the journal entry for buying machinery is an asset. It has to be debited by 60,000 rupees. And again, bank is another asset. The value has to be decreased and we are going to credit what goes out. So here bank is the amount to be credited, account to be credited. So here see the ledger account of machinery to bank account 60,000 rupees. Again on 1/10/2016 another machinery was bought for 40,000. So same 1/10/2016 to bank 40,000 rupees. Next on 31/12/2016, seeing here there is no other transaction. Okay, for 2016 no other transaction. So we are going to take depreciation and we are going to refer working note number A. Why depreciation account is credited? Because depreciation is an expense, it has to be debited, and machinery is an asset whose value is going to be reduced. So machinery usually is debited. When the value is reduced, we are going to credit it to machinery account as a depreciation, and that's why we are taking by depreciation in the machinery account. Let's refer to our working note A now. This is our working note A. See calculation of depreciation for 2016. Total depreciation for 2016 is 5,500. This is the amount which we are going to take to our machinery account. On 31/12/2016 by depreciation, on referring to the working note A, we got 5,500. Now we are going to balance both the sides. So first we on seeing we find that debit side is more. So we take the total of debit side 1 lakh to both the sides and the balance is on 31/12/2016 by balance carried down 94,500. We are going to take the balance of 94,500 on 31/12/2016 to the next year, that is on 1/1/2017. So when it comes here, we call it as to balance brought down. It is 94,500. On 1/7/2017, we have bought machinery worth 20,000. So on 1/7/2017, we know the journal entry for buying of machinery, it is machinery account debit to a bank. So here to bank 20,000 rupees. Next, we don't find any other transaction for 2017. So we directly on 31/12/2017 write the entry for depreciation. By depreciation, refer to working note number B. This is our working note B. Total depreciation for 2017 as per our calculation amounted to 11,000 rupees, which has to be taken to the machinery account. On referring to the working note B, we found out that the depreciation amount is rupees 11,000. Now, on seeing both the debit side and the credit side, we find the total of debit side is more. So we take 1,14,500 on both the sides. On deducting 1,14,500 from 11,000, we get 1,03,500 as the balance of 31/12/2017 and we write that as by balance carried down. This 1,03,500 has to be taken to the next year to the debit side. On 1/1/2018, to balance brought down 1,03,500. In 2018, there is only one transaction. See here on 1/1/2018, 1/3 of the machinery which was purchased on 1/4/2016 became obsolete and was sold for rupees 6,000. So when you sell the machinery, the entry is opposite for buying the machinery. What is the entry for buying the machinery? Yes, the entry is machinery account debit to bank. Now, opposite of that is bank account debit to machinery. Bank account is debited because debit what comes in. We get money, so we debit bank account by 6,000 rupees. Again, machinery is an asset, right? When the asset value is reduced, it has to be credited. Usually asset has a debit balance. When it is reduced, we credit it 6,000 rupees. So in the machinery account on 1/1/2018 by bank 6,000 rupees. Now we have to make the entry for loss on sale of machinery. On 1/1/2018 by P&L we write, and we are going to refer to the working note D for the entry for loss on sale of machinery. On referring to our working note number D, which we have calculated, we find that loss on sale of machinery amount is 10,500 rupees, which will be transferred to P&L account in the machinery account. Okay. Loss on sale of machinery amount is rupees 10,500. The entry for the loss on sale of machinery is P&L account debit to machinery account. Debit all expenses and losses. That is why P&L account is debited, and machinery account is going to be reduced by that amount. What is the amount? 10,500. 10,500. That is why machinery account is credited. Okay. So in the machinery account on 1/1/2018 it is by P&L, and this is what we saw in our working note D, right? So it is 10,500. Next, we don't have any other transaction for 2018, so we directly take depreciation in the year end. 31/12/2018 by depreciation, we are going to refer to our working note C now. On referring to the working note C, we find that the total depreciation for 2018 which we have calculated amounts to rupees 10,000, which we will take to our machinery account now. On 31/12/2018 by depreciation, on referring to our working note C, we found out that the depreciation was 10,000 rupees. On seeing both debit and credit side, we find that the total of debit side is more. So we take 1,03,500. That is the total of the debit side to both the sides, debit and the credit. And on deducting 1,03,500 from 6,000, 10,500 and 10,000, we get balance as 77,000. That is the balance as on 31/12/2018 by balance carried down. This is the exam problem which we have solved now. Please go through this problem thoroughly before your exam. You are going to get a similar problem only for the exam. If you would like to inquire about the online classes which I take, or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.